Cash and liquidity are critical topics in the financial and business worlds. But more and more, cash and liquidity are drawing wider scrutiny, be it from bankers, regulators, governments, the press, and even the public. What's driving the growing focus on cash and liquidity? What challenges do they raise? Why can banks especially benefit from a real-time intraday approach to cash and liquidity? And how do you determine the right cash liquidity management solution for your needs? In this webcast, Gartner Research Vice President Douglas McKibben and Phil Cantor, Senior Product Manager of Strategy and Product Management at SmartStream, offer their insights and best practices for effectively managing cash and liquidity.
Well, liquidity management involves the funding and management of cash and collateral flows in relationship to an institution's contractual obligations and optimizing the risk-adjusted return on those flows. Liquidity risk is the risk of not being able to fund increases in assets and liabilities or to meet those contractual obligations at a reasonable price when they come due. At its foundational level, liquidity risk is an operational risk, but it does have significant credit risk and market risk interdependencies. And with those interdependencies, it becomes an enterprise level exposure and can't be effectively managed on a standalone or as a separate initiative among business units or operating divisions. As with any enterprise level initiative or exposure, it requires bridging the typical functional, business, and cultural gaps that exist within an organization in order to create that holistic and complete view of liquidity. Now, beyond deposits, loans, and cash positions, most institutions are required to manage a range of liquidity risk, whether on balance sheet or off balance sheet, across their retail and commercial business activities. And these include things like currency risk, interest rate risk, or duration risk. And then in investment banking and capital markets trading, these encompass additional, more complex financial instruments across various asset classes that also create liquidity risk exposures. Liquidity risk management is important because the failure to effectively manage liquidity risk is a contributing factor to the current crisis. In addition to the profitability and compliance issues, liquidity risk is critical to the survival of an institution and also to protect its most important assets, which are trust and its reputation with stakeholders. Given its broad information and risk interdependencies, creating a transparent view of risk and enabling timely management action should be a particular focus of IT. But in most organizations, liquidity risk is a patchwork of technology infrastructure, applications, data, and processes that aren't particularly well integrated or consistently managed. And there's a real need for more visibility into liquidity risk and monitoring of those positions. So if you're going to enable that bank-wide timely access to liquidity information and have a quick management response to liquidity stress, it's going to take more than just layering on additional platform applications or dashboards on top of existing business line functionality. Well, probably the greatest challenge of managing liquidity risk is data. It requires a very disciplined approach to data management, including a clearly stated and enforced governance policy, as well as centralized management of data quality. Given the potential volatility of the liquidity risk, it requires consistent, granular, and quality data across business processes, relationships, and various products. And having that single source of data is particularly important to avoiding aggregation delays that are typical of risk management structures that are based on proprietary or standalone applications or separate risk from performance management. There's increasingly an expectation of interactive management of liquidity processes, as well as the expectation of on-demand stress testing. And those type of activities certainly are going to require more of an enterprise data structure. I think in reality what we're going to find is that stress testing will be more at intervals or on an intraday basis rather than in real time. And with that in mind, most institutions, irrespective of their size and beyond just the compliance requirements, are going to move to a more structured, quantitatively measured management of liquidity process performance against corporate objectives. Well, I think it's important to act now because the lack of accurate and effective liquidity risk management really calls into question the adequacy of the frameworks being used by various institutions, as well as the nature of their liquidity risk exposures, which can be very time sensitive and global in reach. The fact that you have liquidity management segregated among various business and treasury activities also stands in the way of getting that complete, timely picture. And when you have middle office activities, which are typically risk and such things as risk and accounting, or back office for clearing and settlement, isolated among various asset classes, that adds to the complexity as well as the risk and the cost. Transparency and speed of information, as well as decision analytics, are particularly pressing issues for liquidity risk management. But even among the various banking and trading activities, you tend not to have a single holistic technical architecture. Instead, you have various business platforms with separate technologies, with the separate data and interfaces that put the institution at risk. Well, enterprise liquidity risk management software is evolving from a number of vendors in the marketplace as a means of creating that consistent view of liquidity risk across the organization. And as opposed to the typically confederated but separate liquidity-related applications that exist in an organization, it provides a number of advantages. One of those is having a common technical framework in order with which to aggregate liquidity information on a consistent basis. This includes the aggregation of payment and transaction information, typically across disparate systems, to give the ability to move cash to the right place at the right time for clearing and settlement purposes. So it also provides increased visibility into intraday as well as forward-looking liquidity exposures in the context of changing market conditions. They can also provide stress testing as well as trend analysis to determine points of liquidity strain. And one of the real important factors is the ability to properly align business unit and enterprise level functional capabilities and data structures to allow those with liquidity management responsibility to make more informed decisions based on those market conditions. Now, it's certainly not possible at this point to buy a plug-and-play end-to-end solution off the shelf from any vendor. Just about any that you look at is going to require some integration of technical capabilities and data structures in order to create that holistic view of liquidity risk.
Well, cash has become very interesting as a result of the global financial crisis. It's very interesting now to bankers. After, for many hundreds of years, not really being very interested in the nitty-gritty of the basic movement of money, of cash and of liquidity, and being more interested in fancy derivatives and exotic products and the revenue side of the business, suddenly cash is interesting again. It's also interesting to the regulators. They've been very active. And it's become of interest to governments who felt the impact of the global financial crisis in a way nobody can remember who's in government has happened before. And it's also become of interest to the press and to the public at large, who have an interesting view of bankers at the moment. So cash and liquidity are interesting. Some of you have heard of cash, some of you may have seen it. You may even have touched it. Just in case not, I've brought some to show you. Here we have a €50 note. Here are 10 American dollars, 10 Singapore dollars, 500 Indian rupees, and 10 British pounds. All are forms of liquidity, they're cash. And if I was to ask you which had the most value, most of you would probably be able to give me a fairly confident answer. But how sure would you be? How would you know right now, unless you had it valued in real time? Maybe you're sitting at a trader desk and you can see the real-time value on the screen. But the interesting thing is knowing the value of all your cash and its location and of all your liquidity and its location at all times, at all points in the day. I mentioned the global financial crisis, and I asserted that that had a lot of relevance to the cash side. How do I know? Well, let's have a look at the Turner Review. So the very first chart in the Turner Review into the global financial crisis, in a section called What Went Wrong, shows quite clearly over $1 trillion of cash held in the Far East, in China and India, Japan, and the oil exporting countries of the Middle East, with an almost exact equivalent around $1 trillion of debt in the Western economies, primarily the Americas and the USA. So as a result of this, we can see that as banks, when we're looking at liquidity risk, when we're looking at liquidity, when we're looking at cash, it's a subject of a lot of focus. And now is a good time to put in for your budgets. So we talked about liquidity risk, and there's been a lot of talk about liquidity risk management, and I mentioned the regulators. The regulators have been very active. If we look at the FSA, they have come up with consultation document after consultation document in the UK, and they've been really the first off the blocks and the most aggressive originally. In Europe, the Basel Committee have come up with regulations in a similar vein, and other regulators around the world are also looking to their regulatory practices and coming up with either new regulations or new supervisory principles, including in the USA. What have they been looking at? One of the biggest things they talk about is stress testing. Stress testing as a way to ensure that the liquidity that you have is enough to survive a stress. So I would ask you this question, however. Having a fire extinguisher, does that mean you don't need a smoke alarm? It's fine to have a stress test to show you could survive a stress. My question is, would you know a stress was happening? During the recent global financial crisis, one organisation suffered a very severe stress. In fact, the organisation failed as a result. During the crisis, its head of liquidity realised only too late what was happening. During the crisis, they continued to pay counterparties out of their funds, but counterparties had stopped paying them, and it was several days before that was noticed. So in theory, they should have been able to survive a stress, but in practice, because they didn't take any action for the first few days, they didn't. So the focus is not just on stress testing for a perspective of could we survive a stress, and more importantly, could the economy survive that bank failing? From the bank's perspective, it's equally about how do we know a stress is happening? And therefore, having systems that keep track of all your cash and all your liquidity at every point in every day, in every location, in every legal entity, becomes a prime concern. And the regulators recognise this. So BCBS 144, for example, which is the Basel Committee regulatory document, states quite explicitly, a bank should actively manage its intraday liquidity positions and risks to meet payment and settlement obligations on a timely basis. And other regulators are doing similar activities on this. So for example, particularly in the Far East, so the MAS and the Hong Kong Monetary Authority, the MAS in Singapore of course, are looking at the practices within banks, and without having to draft new regulations under their normal supervisory rules, are mandating improvements in management of real-time cash and liquidity. I'm aware of at least one bank who have been told quite explicitly it is unacceptable to manage this on Excel, and they need to put in a full system within the next 12 months. So what's going on in cash at the moment is a lot of focus, a lot of attention, a lot of opportunity, but a lot of scope to get the house in order, to get the fundamentals in place so that the liquidity position is clearer and the liquidity risk, which is managed on a longer term basis, can then be correctly assessed. At a recent meeting of senior bankers in the Financial Services Club, there was a very interesting debate on how banks are responding to the global financial crisis and the regulations that are resulting and the new requirements for liquidity management, cash management and liquidity risk management. The title of the talk was Greed or Fear. And what they meant by this is, are banks reacting in a way which allows them to best make money or save money? That's the greed side. Or are they acting out of fear? Fear of being shut down by the regulators, fear of being fined or given a section or given some sort of response from the regulators that will create reputational risk and reputational damage. And the conclusion, almost unanimously amongst the bankers, was while the fear was important and certainly helped the proponents of change within the organisation get heard by the executive committee, the decisions that were made were always still made on a very commercial basis, looking if it was a must-have with no upside at just what is the cost, but pretty well universally saying there has to be some sort of upside here, so what is the way in which we can get benefit from this and which would be the best way? So when we talk about the management of cash and liquidity and where your money is, let me tell you a story about a friend of mine that I worked with when I worked in a major global bank for 15 years. He was the treasurer, and after he retired, I met him again because I'm now working in this cash and liquidity space, and I met him for a chat, and I said to him, when you were a treasurer, and this is only about 10, 12 years ago, how did you know where all your cash was and how much money you had left at the end of the day so that you had enough money and how much you could invest without going negative? So his response was, well, it just seemed to happen. I had a team that did some figures and some analysis, and every day at the end of the day they gave me a piece of paper with an amount on it we were going to invest, and I saw the rate that we were going to get from that investment and I checked it in my head. It seemed reasonable, so I signed it. But how did you know, I asked, whether there was more money that could have been invested? I don't know, he said. I had nothing to compare it against. I spent a lot of my time as part of SmartStream going into banks, working with them, sitting with the people, carrying out the cash management, carrying out the liquidity management function, and watching what they do. We do that so we can make sure our systems fit the problems our banks have. We also do it because it's a very good way of seeing in actual practice how people operate, which isn't always quite the same as what they say. We also study the figures. We get right down into the nitty-gritty of how you can get value out of systems to help you under the regulatory pressure, but help you also with the money factor. So for example, here's some quick examples. One bank was absolutely happy that it flattened all its accounts every day. It knew where its cash was, roughly, and it got the money to pretty well naught at the end of the day, until we did the analysis. Now that bank did something an awful lot of banks do, which is ignore small transactions. It takes too many people too long to check all the small transactions. And by small, they meant less than 1% of the balances. Well, we discovered analysing that was fine in the major currencies, but in Australian dollars, that accounted for 64% of the balance by value, and in Japanese yen, 61%. So 2/3 of that money was simply not being invested, just thrown away. So they were getting no interest from that money whatsoever. Another bank, similar situation in a way. They were absolutely happy with what they were doing in the major currencies, and we checked that, and that was roughly okay. There was a few tweaks, but the minor currencies, which meant South African rand, and they call Swiss francs minor currencies, it depends who you are. For this bank, it was not a major one, and a few other currencies. On a $15 billion buck, they were misinvesting between 5 and 20%, which meant a missed opportunity of between probably around $15 million per annum. Another bank, we found that the cash manager, when he went on holiday, the misinvestment error multiplied 6-fold, went up by 6 times. And the last one I'll tell you is about a bank who got a very late deposit from another bank of several $1 billion. They didn't notice, so they didn't invest it that night. In the morning, they came in and found they had a $2 million interest liability they had to pay. As the product manager said to me, thank God it wasn't a Friday. So in summary, in terms of how banks are responding, all the banks I speak to are doing the right things around stress testing, either putting in a complex system or doing some stopgap transitional arrangement until all the regulations around the world are aligned. But I think the interesting and sometimes less well advertised activity going on is the banks are taking this opportunity to really get their internal systems sorted into the new century so that they have a much more accurate and a timely position of all their cash and all their liquidity at every point in the day. And the analogy I would draw here is that the manufacturing sector really got their act in order at the end of the last century with just-in-time and Six Sigma and stock control and inventory management, which means they know where every part is every moment of every day. In some ways, it's, let's call it kindly, a surprise that banks haven't yet got there and they don't have this information. Increasingly, banks are doing that with systems such as the SmartStream system. The regulators, of course, have been very active in the press and in the financial sector industry, drafting new regulations and exercising supervision, and, of course, making sure that they have the right PR for themselves as a result of the crisis. A lot of their activity has been focused on increased liquidity buffers, and one might just ask how much liquidity buffer we need worldwide and whether that will indeed achieve the result, but it's certainly seen as an important plank in the regulatory framework. Stress testing also is important, and we have discussed that. Now, one other area, however, that's getting a lot more attention and getting more aggressive in certain jurisdictions, particularly the UK, but also in France and in the USA, is the way that banks look after not just their own cash, but other people's cash, the client money segregation issue. This came to the fore particularly because of the court case over Lehman Brothers, which is still not settled at the time of this webcast. Client money segregation is not the most exciting part necessarily of banking, but if a client gives you some money to hold in trust, rather than buying one of your products so that it becomes your money, they sort of expect that you look after it and that you know that it's theirs and that you invest it in an account which is held by a third-party trust company rather than held by yourselves, so that should the worst happen and you do have to be liquidated, the client can get the money back. And anybody interested in the Lehman's case would be able to discover some of the problems arising on that. And there are systems, such as the SmartStream system, which will keep track of all that money for you. And this may help you avoid getting a fine. And in case you think these fines are not important, the last fine that was levied by the Financial Services Authority was on JP Morgan for $50 million. So the regulators are very active on a number of fields. They're getting more interventionist, more aggressive, and they're making life rather more complex for bankers. Just one statistic. There is an estimate from PJ DiGiamarino, who studies regulations worldwide, that currently there are 100,000 pages of regulation for a global bank to be familiar with an estimate of 250,000 pages by the end of 2012. Approximately 30 plus reports every month And you know what? They're not easy reading. Liquidity risk, therefore, has always been done traditionally at a fairly senior level in the bank, in the ALCO, the Asset and Liability Committee, based on often statistical models and broad brush analysis of the types of business and then the information and data when it can be got. And there's often an army of people behind that trying to create the information. I think as we go deeper into the new century, we're seeing a new approach to this. What we're seeing is we can underpin all of that work with real, live, timely, intraday, if necessary, or end of day if desired, accurate, specific information about every legal entity, every currency, in every location of that bank. So intraday cash and liquidity management can provide a good calibration of the more esoteric ALM activities. The second thing is we can start to put the problems where they belong. So with these intraday systems, we can start to introduce proper funds transfer pricing. We can start charging for liquidity. So instead of just measuring it and evaluating, we can start improving it. Innovations such as the concept of a systems defined or a systems held funding policy defined by the bank, which checks every day the actions that are taken and monitors it and provides MIS to allow the bankers to look at that and decide, actually our haircuts should be 20.3%, not just round numbers, 20%, all helps us bring some science to managing liquidity. So if we then look at how that affects all the Nostro reconciliation that goes on around the world, the checking, the activities that just try to make sure that in the operations of the middle and back office of a bank, all the trades are known exactly where they are, whatever system or systems they happen to be going through at that moment, at any time, so there are no breaks and everybody can see exactly what's happening with broken trades, whether it's client money or not. It all means that the accuracy and the reliability of the ALM activities and the pricing going on is that much more accurate, that much more real time. And the bottom line is not just about satisfying the regulators, but about making more money for the bank.